Excellent. Good morning then. Second day of August, and I don't know, things not looking particularly pretty here as we get this session underway. Definitely some, there's definitely some undercurrents of, genuine nervousness beginning to creep back into this financial market system. We've had this weird, and it has been very weird, period of calm after the Brexit vote, and I think if I'm looking at three equity charts here, I'm looking at the Euro stocks top left, the DAX on the right, and then S&P bottom left. Maybe the S&P is the best one to kind of just measure that calm, because here you can see it perfectly. Big sell-off off the Brexit vote, and then snap back, new all-time highs. But look at the last couple of weeks. It's just been absolute flat line right at the highest levels this index has ever traded. And so volatility is just gone. It's vanished. Volume's gone, which is quite typical for a summer period. In fact, we've made new all-time highs yesterday. So this index here, the S&P, reflects this calm. Now, when I say there's perhaps an undercurrent of nervousness and risk coming back into the market, you definitely can't see it in this chart yet. We're still absolutely happy, trundling along sideways with almost no volume or volatility whatsoever. But look at my DAX chart on the right here, and this is now zooming in on a 1 hour time frame. So the DAX just moving down. Actually, let me just move that line, because we have a low here from Friday. We're just testing it. 10,260. So definitely negative vibe on equities this morning. Even the S&P is moving down, which I thought had been made illegal. I thought the SEC and the Fed had made that illegal, but it looks like it's actually happening here. Look for a move to the low point from yesterday morning. Yesterday afternoon, I should say. Anyway, what's going on? Look, there's the DAX down through that level from Friday. So there's a couple of things. Well, there's a few things, obviously, but I think let's talk about Japan first. So certainly, we've got to talk about Japan and we've got to talk about Italian banks. That's the key lead forces right now, this morning. So firstly, Japan, and they have just announced their 7.5 trillion yen fiscal stimulus package as expected. It's literally just hot off the wires. About 10 minutes ago that's been confirmed, except that actually it's really just continued reaction, I would say, in the bond markets as a result of the Bank of Japan's efforts last week, where ultimately, yes, they did increase their QE package by deciding to buy more ETFs, but actually it was a bit underwhelming. Let me show you a chart here of Japanese 10-year government bonds. So look at this move to the upside here on yields. Okay, so that's yields moving higher, which means prices are dumping. But when you look at it on a daily chart going back, looking at the whole of 2016, this is a big move over the last couple of days. Ever since that Bank of Japan meeting last week, this has been the biggest move to the downside for prices. This is a big sell-off in Japanese debt as a result of the underwhelming efforts by the Bank of Japan last week. Now this is triggered and fed through this morning to actually movement in to the downside in debt, globally. If you look at the bond, I'm going to show you the T-notes and the Bund here. So T-notes top left and the Bund bottom right. The Bund's been selling off, hitting technical support back on Friday's low here, but you've got downside across European bond space, downside in US bonds less so, but it's the Japanese bond market sell-off that is a concern. It's the biggest 3-day move to the downside we've seen for years in Japanese debt. However, let's get this into perspective. The 10-year bond yield is still below zero, but it's the scale of the movement in such a short space of time. That's one thing. We've had the Australian central bank cut rates overnight as a result of lackluster economic activity and lowball inflation. And then we've still got the fallout from the Italian banking saga and the European stress tests that were delivered on Friday night. I think let's look at the Eurostoxx chart for this. This sums it up pretty nicely, because check out what's happened here over the last 24 hours. Big gap up at the open on Monday morning, and then a clean sell-off right the way through the session, and a sell-off that's just actually substantially extended as I've been pretty much talking here. So big downside on European equities here, entirely reversing that move. Do you want to know how long the positive move on European banks lasted on Monday morning? Following the stress tests, that's the stress tests where apparently everybody passed, except you're not allowed to say if they've passed or failed. But Allied Irish Bank and Monte dei Paschi basically failed, of course. But the relief rally in European banks lasted 6 minutes. They opened up 1.7%. So they managed to move upwards for 6 minutes at the start of yesterday's session. They then turned and sold off straight for the whole day. Banks like UniCredit down 6%, for example, on the session. And two things, particularly the Italian banks suffering as the DAX takes another leg lower down to S2 here now. Two things. Firstly, the deal done for Monte dei Paschi saw them shift their bad loans, non-performing loans, their NPLs, shift those off their balance sheet, 30 odd billion euros worth. But the key was they had to write them down by 70%. So they had to value them at 30 cents in the euro. Now the problem with that is that's a way bigger write down than analysts had been kind of using as a measurement to value non-performing loans across all of Italian's banks. So now the panic is, well, hang on, if Monte dei Paschi have to write down, take a 70% haircut on their NPLs, well then if other banks had to do that, then actually several banks are going to need to go through capital raising. The ECB, ironically, and this is the beauty or the just ridiculousness of it, they did their stress test literally on Friday, results came out, and already, given the action on Monte dei Paschi, it's now looking like these stress tests are entirely invalid, and actually many Italian banks need to go through capital raising. So that's a big panic, the fact that Monte dei Paschi took a 70% haircut. The other thing is 5 billion euros to bail out Monte dei Paschi, probably not enough. So whilst it's a bit of a patch up, I think there's still panic in the market. It's just too little too late. So that's why you got this big reversal in European equities generally, but obviously led particularly by banks and Italian banks specifically. So that's the other big thing in the mix here. These are the two factors, Japanese bonds, and then the Italian banks are leading to this risk off this morning. Add into this then the fact that oil took another big move to the downside yesterday. Let's bring up the oil chart. 3.7% down for the session, and it just continues. This has been a very extended move now. Look at this on a daily chart. Quite phenomenal, really. 9th of June, we topped out for the year, 52.73, and it's been one-way traffic, and look at the consistency of this move to the downside that we've had over the last couple of weeks. As soon as we took out $45, it has been free fall down to now $40, where we broke actually briefly. We bottomed out at $39.82 yesterday. Look at this low we had back in April. This is on at $38.67. This is a non-continuation chart, by the way. So this is just looking at September futures only. But another big move to the downside. Of course, this is not helping with just the general vibe in the equity space globally. So certainly energy sector getting hammered yesterday. So what's going on here with the oil price? A couple of things I would say. Firstly, here's a chart to think about. This is a big reason as to why we've seen this crude move to the downside over the last few weeks. This is the Baker Hughes rig count. And as you can see, this thing's been in free fall ever since January 2015, literally down. And we had one brief respite, summer of 2015, and then it's just been down. But here we go again. Maybe it's seasonal. Just thinking now, as I see this chart, we did tick slightly higher last summer as well, briefly. So maybe it is seasonal. But what we've had is consistently, for the last 1 month, a move to the upside in the Baker Hughes rig count. As price moved up to $50, It looks like these producers have turned their rigs back on, or at least some of them. I mean, this chart, though, I mean, it does definitely tell you that we're still at the absolute very bottom of a collapse here in active rig counts. But anyway, because of the direction of the last 6 weeks on the rig count, this is perhaps showing that US crude production is going to go back up. And when you look at the actual production stats, then that does stack up, because we have had some increases in production. This is looking at a 5-year chart, so actually all you can really see here is the downtrend of the last 12 months. But if we look on a 1-year time frame, then you can see that yes, we've been trending lower, but ultimately over the last 6 weeks we've gone back up. So production back on the up, rig count back on the up. Throw in the fact that Libya have just perhaps opened the way for 3 of their biggest production fields to reopen. That's positive for supply. And then Saudi have just cut their wholesale prices to Asia by the most for 10 months. So these are your big 3 catalysts for crude on the downside, and that's just not helping with risk appetite in the equity space when you got an Italian bank crisis and Japanese debt selling off, sharpest sell-off that we've seen for well, all year. So this is what's feeding the fear here. Let's talk about the UK briefly before finishing on the US. So UK data, we got big event of the week is a Bank of England event on Thursday. Are they going to cut? Are they not? What other stuff can they do? You know, Carney in the aftermath of the Brexit vote was talking about the need for a package of policy over the summer. The word package implying that interest rates perhaps aren't the only tool they're going to use, so we'll see. But checking out on the UK data and just looking around some of the other UK data, because the reason they didn't make a move in July, which was only 3 weeks ago by the way, their meeting, but the reason they didn't make a move is because they had no data on economic activity after the vote. But now we're hitting August, now we're going to get some data, and we've had some. This is ahead of their meeting on Thursday. So check out here, for example, first up, Exhibit 1. This is the manufacturing PMI. And so this is the July reading announced yesterday. And of course, we've dropped sharply, got revised lower. In fact, if you look on a 10-year chart, then this is the lowest the manufacturing PMI has been since 2013. 3-year low for manufacturing. Remember, any number below 50 here on these PMIs indicates contractionary conditions in that sector. So obviously this is bad news and signaling a recession. Check out the services side. Well, this is the services number, which needs to get confirmed or revised potentially later in the week. I think it might be tomorrow. But anyway, the preliminary reading here is down below 48. And check this out on a 10-year chart. This is even worse. This is actually a 7-year low for services. Remember that services makes up the lion's share of the UK economy. These 2 PMI readings indicate a recession. Not that it's coming, that it's here. There's other stuff. If I look back, look at like business confidence. These are all soft data readings that are measuring conditions in July, which is of course post the vote. This is the business confidence index. Wow, it just looks absolutely shocking, and again the worst it's been since the crisis, so 7-year low. So these are the kind of stats that Carney and his team are going to be looking at on Thursday. Are they going to cut? Are they not? Well, actually, when you look at the pound, and let's look at some of these currency moves this morning. When you look at the pound, I'll bring the euro up here as well at the bottom, and let's have a look at the yen. Actually, wow, just as the DAX continues to go south here, so this risk-off vibe continuing. You've got yen strength. On the right-hand chart, you've got dollar weakness generally. So whether it's yen strength, we did have a technical move breaking below Friday's low on dollar yen, that is. But you've definitely had some dollar weakness. Sorry, let's get the euro dollar on the bottom. Dollar weakness this morning, although I've just been, we had a move higher for cable, but it has been given back a little bit now. But look, I think the euro dollar is the more important chart to look at from a currency point of view, the bottom left chart, because we're up at the highest levels we've been since the day after the UK referendum, this big sell-off here as a result of the referendum vote. And this is the highest we've been since then. So that's a 6-week high here. So you're getting a bit of dollar weakness across the board. But I was going to say, at the moment, ahead of the Bank of England, if I go to a daily chart for cable, things are quite calm here. It's not like we're pricing in anything aggressive. I mean, we do stay, I guess, consolidating at the very bottom of the Brexit spike lower. So we kind of haven't, we've had some volatility, but ultimately here we are right now trading the price we bottomed out at on Friday, the 24th of June. So you would say this has been noise, and we don't really know where to go yet here for cable. Is this low enough? Is it too low? Or actually, are the Bank of England going to be aggressive and we need to go lower? And I think at the moment, given how the political climate has calmed in the UK, that is, then maybe this means the Bank of England will prefer to be more cautious. So we'll see whether they're going to feed us a cut tomorrow or not. Not tomorrow, Thursday. Talking about politics, just very briefly, one thing that might offset all of this negative sentiment is an updated chart here, just thinking about the White House race, an updated chart of the opinion polls. And actually what's happened is Clinton's made a move, and actually the spread here is the widest in Clinton's favour that we've seen, well, probably since the middle of July there. So certainly quite a big divergence here in the last couple of days. It doesn't matter what your political views are. From a market point of view, that's positive. So now that we're talking about the US, let's continue with that theme. We'll talk about earnings briefly in a second, but firstly, Dudley made some comments overnight. That's Fed's Dudley, who's normally dovish, and so thinking about what are the Fed going to do here? Are they going to hike this year? Well, according to Dudley, they may well do, and this is quite a hawkish comment for Dudley, who's normally dovish, and Dudley's pretty important in the Fed, in the FOMC, the New York Fed chief. So he said directionally the movement in investor expectations towards a flatter path for US short-term interest rates seems broadly appropriate, but here's the hawkish bit. He said, however, it's premature to rule out further monetary policy tightening this year. And he went on to add that should the incoming data validate his view of the outlook, then US monetary policy would need to move at a faster pace than implied by futures markets. So obviously we're data dependent here. Kaplan, who's more hawkish, actually went and said that actually September's a live meeting, but whatever. I think that non-farm payrolls on Friday is certainly important. I'm just going to bring a chart up of that. We've had so much volatility in this data. It's hard really to know where we kind of stand on US jobs. Certainly the ISM manufacturing number yesterday, the employment component was bad, but huge volatility. Really don't know what to think here. The averages are fine, around 200, but are we going to get more volatility and another big move lower here on payrolls? If we are, then the Fed are going to find it impossible to hike. But if we get another strong reading, well, maybe September is on the cards, obviously depending on European banking crises and so on. But payrolls on Friday is obviously an important event. Just to finish on then, let's have a look at the calendar and just talk about the earnings season. So the data calendar here, what have we got served up for today? We got more data out of the UK for July. So any of this stuff's important. Normally the construction PMI for July in the UK wouldn't really register too much on the radar, but given its data about July and important news for perhaps the Bank of England, this will get a higher, this will carry a higher importance than it ordinarily would. PPI data out of Europe at 10, so it's pretty quiet for data this morning. In terms of the US, well, we get some deflator and core PCE numbers at 1:30, consumer spending also, but we had the GDP figures, of course, on Friday, so this lot less important. It is June data, this, so it's a bit old. And then tonight we've got the API crude oil inventory data, which is important, of course, given the fact that crude broke below $40 briefly yesterday. On the earnings front, we have got the likes of Pfizer and Procter & Gamble today. Here are some auctions just to finish off, but just finishing on earnings. You know, it's a bit quieter yesterday on the earnings front, but here are some stats for you. So far, 316 of the S&P 500 companies have reported, and so far 63% of them have beat their EPS, their earnings per share expectation. 63%. So you might think, wow, that's good. Obviously, that's above 50%, more than half beating expectations. But two things to say about that. Firstly, that's really depressed expectations as they get revised lower, ever lower as you're going into the season. And number two, I can't remember a US earnings season where the EPS beat was not above 70%. I literally can't remember. I'd have to look at that. I think it's years and years, maybe since the crisis, since we've had a quarter of earnings where we haven't had the average EPS beat above 70%. The other thing on the revenue side, that's pretty ugly as well. I've lost the number now. Yeah, only 34% of companies have beat on revenue. And again, that's the lowest I can remember, maybe since the crisis. So we do continue to see earnings generally being weak. We are in an earnings recession. If you look at EPS on average for the index, then it's minus 2.2% for the quarter. But if you take the energy sector out, it is positive at plus 2.8%. So it's tricky to know, without the energy damage, maybe these equity markets are kind of, or the earnings recession is bottoming out, but it's difficult to kind of see because of the noise. All right, anyway, that's it for now. Look, you got a real risk-off vibe. Certainly, you get yen strength, which is classic signal. That's my top right chart. Classic signal of risk-off. You're seeing that reflected in big downside for European equities this morning as we get a continued fallout and reversal following the European bank stress tests last Friday. Japanese bonds have taken a dump, and this is fed through to that kind of taking down bonds generally, although I am seeing the Bund has now bounced quite sharply off that Friday low from last week. So this is the vibe, these are the conditions. Let's see how we go, guys. That's it, briefing done. Enjoy the session.